Hi, I'm Donna Roseman David, Senior Gift Planning Officer at the Hartford Foundation for Public Giving. Recently, the Jewish Community Foundation and the Hartford Foundation invited Ed Beckwith of Baker Hostetler in Washington, D.C. to speak to area professional advisors about charitable planning in uncertain economic environments.
Today's current economic concerns really set the backdrop for a tremendous opportunity in revisiting people's planning, and one of the areas where they will find significant opportunity is what's known as a charitable remainder trust. Now, I think it's probably helpful to begin by understanding what we mean when we say a charitable remainder trust. This is simply a trust device where the donor transfers some asset or assets to an individual or an institution which we identify as a trustee. That trustee then holds the asset for the benefit of one or more private individuals for a period of time. When that period of time is over, if there's anything left, what's left goes to charity. That's where the name of the device comes from, Charitable Remainder Trust. The Charitable Remainder Trust really has two broad types. It has a Charitable Remainder Annuity Trust and a Charitable Remainder Unit Trust. In the Annuity Trust, from the very first day when we create and fund the trust, we know that a fixed amount will be paid on a regular basis throughout the term of the trust. With a Charitable Remainder Unit Trust, we know on the day that it's created and it's funded that a fixed percentage of whatever the pot is worth each year will be paid out to the one or more private individuals until the term concludes and what's left passes to charity. So we have certainty either in a fixed amount or what I'd call a variable amount, and that's the difference between a Charitable Remainder Trust, Annuity Trust, and Charitable Remainder Unit Trust. In the current economic environment, there are actually three tried and true uses of a Charitable Remainder Trust that can be very helpful to a family in rounding out a full private wealth plan. First and foremost would be the individual who is approaching retirement or starting to think about retirement and using a Charitable Remainder Trust as a supplement to their retirement plan as a way of assuring that a certain amount will be paid to them when they retire or if they're already in retirement. One of the reasons why this is helpful is because when we create the Charitable Remainder Trust, if it's properly formed and it's properly operated, the Charitable Remainder Trust is a tax-exempt environment. So we can take assets which have already appreciated significantly in value, and despite the current economic downturn in the marketplace, there are still a lot of people who've been saving for many, many years and have assets which, although worth less today than they might have been worth just a year ago, are still worth a great deal more than the day they purchased them. And so they can take these assets and transfer them to a Charitable Remainder Trust, reserve one of these annuities, fixed or variable, for themselves, and provide a greater return on an ongoing basis for themselves than the marketplace is currently providing for them. In addition, they will get an income tax deduction when the trust is first created and funded, which will also help reduce their cash flow currently, and they will be able to provide for a charitable gift at a time when they no longer need the resources themselves. Now, very often when you explain this type of a transaction to an individual, family members will say, well, that's all well and good. You have done a very nice thing for yourself, and you've done a very nice thing for charity. But what about me? I'm the next generation. Doesn't your will provide a gift for me? Doesn't your estate plan take me into account? And here, life insurance planning can supplement the Charitable Remainder Trust planning. Here, what we might do is take that income tax deduction I just described and use it to fund a second trust. This would be an irrevocable trust for the benefit of children, maybe grandchildren or great-grandchildren, and the trustee might purchase a life insurance policy with that money so that when the remainder trust matures, when the individual who created it dies and what's left goes to charity, the second trust will then blossom in value as the insurance policy pays off and provides a benefit for the children and grandchildren. The win-win here is that we get an income tax deduction here. We use those resources to fund the insurance trust. If the insurance trust is properly formed and properly operated, those assets won't be subject to estate tax when our generous donor dies. So there are two techniques in the current economic environment that can be very helpful, even though they're tried and true. They've been used for years. They're very safe techniques, and they are devices which people are quite familiar with. Now, there are any number of people that we can benefit with this. I don't have to reserve the annuity to myself. I can reserve it for my spouse. I can reserve it for others in my family that I care for or who may be relying on me in some fashion. And in this day and age, with people living longer, one of the things we see is that some of our parents are outliving their retirement savings. And so if you just substitute parent for donor as the beneficiary, although there are other tax consequences to take into account, the dynamics are essentially the same. I could substitute child for parent. One of the things that is very interesting to people is that you can actually fund a college education this way. You can save from the time the child is born until they're about ready to go to school. And you may have a highly appreciated basket of assets. You can take that basket of assets and transfer it to charitable remainder trust, very short term, because although the child may want to go 5 or 6 years, we're going to make it a 3 or 4 year trust, and we're going to use a very large annuity paid out to the child so they can pay their own tuition for a period of time. If there's something left over at the end, how about leaving it to the university? My guess is that when that child crosses the stage to get her or his diploma, the president of the university is likely to know who they are.